Welcome back to another exciting episode of the show called One Step. Let's talk about the journey, where we explore the journeys of entrepreneurs, business owners, innovators, thought leaders from all walks of life. I'm your host, Joel Bennett, and today we have a truly valuable episode for anyone interested in securing their financial future. Have you ever wondered how to protect your asset and ensure financial stability through the ups and downs of life? Or perhaps you are curious about investment strategies that can help you grow your wealth over time. If so, you are in the right place. Joining us today is none other than Dermaine Whittaker, an expert in the field of finance and investment, with years of experience helping clients navigate the complexities of insurance and investment. Dermaine Whittaker is an investment broker, and he is here to share insights and give us practical advice that can help us make informed decisions about our financial future. In today's episode, we will deep dive into the different types of insurance you should consider, from life and health insurance to property and liability coverage. We will also explore various investment strategies, including buy and hold, dollar cost average, and more. Dermaine Whittaker is here to help us all build a robust portfolio. If you are in that vicinity or that status of life and you want these information, stay tuned. I guarantee you that there will be jam-packed information and more. Mr. Whittaker, welcome to the show, my brother.
Thank you very much.
We had so much fun the last time. We decided we have to do it again. So, just to break the ice, Mr. Whittaker, I have a question here for you, icebreaker question.
Sure.
If you should choose a superpower, you know, some rock fall from the sky, some genie show up and they give you the option of choosing one superpower, what would that be, Mr. Whittaker?
Oh man, that's quite a question.
I know.
One superpower.
Just one. You have to choose one.
I think it would have to be something, some kind of power that really allows people to find and utilize information at a much higher level,
Okay.
right? I don't know what exactly to name that power, but it would be maybe a superpower of gifting knowledge.
So mentally influencing people.
Something along that line, but just being able to transfer that knowledge, you know what I mean?
Yeah.
Or at least making people, because we have information available, but if there was some way we could make people a little bit more open, a little bit more focused, a little bit more aware, right? If there was a superpower, that's the one I would want to have.
So in other words, Mr. Whittaker, you would be given a power, and you would choose a power that can make other people powerful.
Absolutely.
Walking around with everybody with mental intelligence.
I'm telling you.
We'll have a world filled with brilliant minded people. And that would kind of, hopefully, that would make us human beings better people. Wouldn't you say?
I absolutely believe so.
Gosh. Wouldn't that be a dream? Anyway, I like it. I was thinking otherwise, maybe invisibility, reading minds, being able to fly, shooting fireballs through our eyes.
Yeah.
You want to make people smarter.
I want to make people smarter, Probably would have been one of those things if it was about 30 years ago, but
but now you're on a different platform.
Totally.
I appreciate that, my brother. So let's kick this off with a case study.
Sure.
John D. Rockefeller, one of the wealthiest individuals in history, utilized life insurance as a part of his estate planning strategy. By leveraging life insurance policies, he was able to ensure that his wealth was effectively transferred to his heirs, minimizing tax liabilities and preserving his fortune for future generations. So we're talking about generational wealth.
That's right.
His use of life insurance helped set the standard for modern estate planning among the wealthy. I've heard this, let's tell you, Dermaine, I've heard this many times, but there is so many different sides to it. And today I have an expert on here. So I'm hoping that you will dissect this statement and, you know, make it simple for those that were once in my shoes who quite didn't really get it.
Right.
Know what I mean? So if you could dissect this statement for us, because this is facts right here.
Yes.
And tell us how this unraveled.
Yeah, for sure. So I want to kind of set the record straight. I know you throw quite a few titles out there as it relates to my profession and what it is I do.
Yes.
I want persons to understand that I am a financial services professional.
Okay.
I am a broker in the sense of the fact that I provide multiple financial services.
Yes.
All right. So, you know, sometimes the industry and the compliance, you know, professionals can be a little bit more, they're a bit more sensitive, you know, in terms of what titles we're using. So
for sure.
we just want to be mindful of that. So
Absolutely.
yeah, in terms of insurance being utilized for estate planning and estate transfer, it has been around for a very, very long time.
Yes.
Unfortunately, it is a strategy that only a limited few, you know, have been aware of. And you know, so when you look at the average individual or the average family, you know, a middle income household family, for example, oftentimes they don't really have much knowledge around how to utilize, you know, insurance provision to ensure that they have maximum tax efficiency, right? To ensure that, you know, their estates are, you know, transferred in the most effective way. And reason for that too is because a lot of people aren't really thinking about those things, right? People tend to believe that if they don't have a lot already, then there's no need to be thinking about the next generation, right? So that is an issue all by itself, and that also ties right back in to the concept of an insurance policy. Because if I am a young family man with small kids and I am building my career and establishing myself, and I don't have any sums of money or large sums of money or deposits or assets, a life insurance policy can allow you to purchase an estate before you're able to build one. So for a lot of, let me say for most people, they will find a lot of meaning there, right? Because you can purchase an estate via a life insurance policy before you're able to actually go out and build a business.
When you say purchase an estate, Dermaine, can you explain that?
Yeah, so what we're talking about is you can go and buy a life insurance policy, right? Now, what the life insurance policy is, it is pretty much transferring the risk from your family in the event of you passing away to the insurance company, insurance provider. So you're transferring the financial risk from your family to them. So the exchange is you pay a small amount relative to the premium typically, and so if anything happens, then they would pay your family a large amount, right, of money, right, to again compensate for the financial loss of you passing away prematurely, right? So when we talk about purchasing that estate, let's say a client was to go out and get a policy for $1 million. All right. You get a policy for $1 million. Well, you are in your financial journey, let's say you're at the onset, you haven't established yourself, you don't have a large savings account, you don't have any acquired asset, but you can go out and you can purchase all of $1 million in life insurance policy and pay a relatively small amount in premium. That life insurance policy now represents your estate.
Your estate, okay.
Right?
Okay.
So before, you had nothing to pass on to the next generation.
Yeah.
But now, via a life insurance policy, you have something substantial to pass on to the next generation.
Yeah.
And that's a very, 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 very powerful tool.
So the Rockefellers, they have been purchasing huge or high-rated life insurance policies on themselves, and establishing it to be passed on to their bank accounts, their wealth portfolio. Like, how did they do it? Like, I know that you touch on that, but make it simpler. Like, what did they do exactly?
Well, I mean, the issue is not what they did exactly, because no one scenario is going to fit all, right? Fundamentally, Joel, what we want to do is to understand the concept of life insurance policy, right? What is the concept of owning a policy so that you can protect your loved ones and your beneficiaries, and you can create generational transfer, right? So if you understand that concept, where if I'm not around, I can have a substantial amount of money be released to my loved ones, right? Then essentially you're alleviating a lot of the financial burden that would have existed if that money was not available.
Okay.
But you're also affording your next generation, it could be your immediate family members, lots of opportunities also for financial empowerment, right? Because if you get a lump sum, right, there are stories of families that had insurance policies, and one insurance policy converted into ownership of a business, and that business blew out of the park and became something that lasted generations. So essentially, that's the mindset that the average person, or should be having, the masses should be having around insurance policies. Because the truth be told, those people that are already wealthy are just a minority. Right? But even so, they also utilize life insurance policies as a means to tax shelter their wealth, but also as a means to ensure tax efficiency in terms of wealth transfer. What that means is less money goes to the government and more money goes to your loved ones. Right? Nobody wants to be working for an entire lifetime just to find that the majority of their assets went to the government, through the probate process, or goes back to the creditors because they had some monies owing, right? So life insurance policies allows us to tax shelter monies, have assets for our families that are protected from creditors, and put our families in a much better shape to continue on the journey of life, when we are no longer around.
Very valuable information, Dermaine. Thank you so much for that. Okay, so let's get into this. Can you dissect or explain or list the various types of life insurances?
There are a lot. there are quite a few.
The main ones, if you could touch on the main ones that you think people might need to know.
So the main ones, the main two categories of insurance policies are term and permanent. Right. So you can one can get a term policy that spans various different terms, whether that is 10, 20, 30 years. Sometimes we can customize it for an exact number of years as well, depending on the company and what they have available. And then on the other side, with the permanent insurance, in Canada we have a universal life insurance contract policy, and we also have like a whole life policy. The whole life policy comes with guarantees. It's a bit more pricier, right, because of those guarantees. Anytime you're purchasing anything that comes with guarantees, it's going to cost you a bit more, right? So whole life is a bit more pricier. compared to a universal life contract.
Why is whole life more pricier? Because you mentioned term and whole life. Right?
Yes.
Let's get into whole
so
life.
the whole life is more pricier fundamentally, because one, it is a lifetime policy.
Yeah.
So that is what whole life signifies. It means that this contract is going to pay out at some point.
Yeah.
Right? Because no one lives forever.
Of course.
Right?
You could have asked for that superpower.
Well, I mean, I'm not sure if that's one I'd like, but you know what I mean? But yeah, I mean, the whole life is intended to last a lifetime.
Yeah.
So it is going to pay out. But again, you're going to find higher premiums within a whole life policy compared to any other form of permanent life insurance policies, particularly a universal life life insurance policy in Canada here.
Yeah.
Because within the whole life policy, there are going to be guarantees in terms of the returns. So when you get a whole life policy, it has a saving / investment component. Okay. So every month you pay your premium. A little bit of that premium, it could be a significant amount depending on how much you're contributing as well. But a portion of that premium goes into the savings portion. Now, with your whole life policy, those extra contributions, they attract a dividend.
Okay.
Right? So a dividend is actually paid out by the whole life insurance companies. Typically, it's pretty fixed. The dividend rates doesn't fluctuate much, with market conditions. And so, persons are able to see, in most instances, a consistent return on those investments.
Okay.
Right? With your universal life contract, it's a bit more affordable. Why is that? Because it doesn't come with the same guarantees. The savings within those contracts are invested, and then the returns you see are based on market conditions. So that means your portfolio could be up, but it could be down in any given year. I'm fairly confident that both contracts can work quite effectively once it is structured properly.
You mentioned term. Is that's not the same as universal?
No.
What is term?
So term is a temporary contract.
Okay, explain that.
Right. So let's say I'm buying a house. I'm just going to use an example.
Yeah, for sure.
Let's say I'm buying a house. I'm going to have the bank is giving me 25 years to pay off that mortgage. So for all of 25 years, let's say I have a $500,000 mortgage, I'm going to be owing, if not all $500,000, shouldn't be all right? But at least I'm going to be owing some amount of money over those 25 years.
Yeah.
So I may say, hey, I want to protect this asset for my family. Like, if anything should happen to me and I'm not around to pay that mortgage, I want my family to be able to stay in that home. Right? So I may go out and I may purchase a term contract. Why term? Because the purpose of this particular policy is pretty much just to cover the asset. And I'm scheduled to have a liability on this asset for 25 years. So I want to purchase a life insurance contract for 25 years.
Okay.
Right? So again, a term contract is really meant to last
a period of time,
not for a lifetime.
Okay.
Now, with term contracts, they do renew. In most cases, right? So the insurance company will give you the opportunity. Let's say you had a term 25, year 25 came, they're going to reach out and let you know that your policy has expired and it's up for renewal. You can decide to keep the policy after those 25 years, but the premiums goes like bananas, right?
I can imagine.
Yeah, the premiums are a lot more higher than than what you would have been paying over those 25 years. So that is really the drawback of a term contract. Now, a term is great because it's affordable. However, we find, and I have found in my career, that it's very important to balance affordability with need, right? So this is what my client can afford, but what do my client need? Now, one of the things we have all mostly agreed on is that all of us have a long-term need for insurance.
Of course.
Why? Because
We know we're going to die.
we don't escape alive, okay? Right? So, the term is great, but, we always, will encourage our clients to think about having some amount of permanent coverage in place just to have that for the long term, right? So you don't want to be shopping around when you're 65 years old for an insurance policy because the term expired and the premiums became unaffordable.
You made reference to one of the policies that involves paying a dividend. Is there any, or are there any penalties attached to if, let's say, 5 years down the line, you decide to withdraw some of that gain during the whole process? Are there any penalties?
So it depends on how the contract is structured, and how it was paid.
Yeah.
But generally speaking, a lot of contracts will have surrender charges, particularly within the first couple years of the policy, anywhere between year 1 and year 10. Usually there are surrender charges.
Explain surrender charges.
Will apply. So surrender charge is a fee that is assessed to the client if they do choose to relinquish the policy.
But they're not relinquishing the policy. They're just withdrawing the profits or the gains over time. We're not closing the policy. Let's say an unfortunate situation befall me or my family, and I've gained some benefits, or I've gained equity of maybe about $5,000 to $10,000, and I want to use that. I want to withdraw that. I'm not closing the policy.
Okay.
I'm just withdrawing the.
Well, thanks for the clarification. So if it is just a withdrawal, providing that the balance can accommodate that withdrawal, typically it's fine. The client can go ahead and withdraw the money if the cash value is there and the term of the contract allows them to withdraw within the time period, the timeline that they since they set the policy up and they're making that withdrawal, right? Again, it's going to be dependent on how the policy is structured. Did the client make some deposits or not, right? Like, were they really contributing significantly enough to build up that cash value, right? But typically, as long as the cash value is there, it is accessible to the client. There may be some form of tax implications when a direct withdrawal is done from like a permanent insurance policy, and so that is something to be mindful of. So persons want to be talking, with their advisors, with their tax accountants, as it relates to these tax implications. But of course, as financial professionals, we are providing that guidance as well.
In my opinion, I really wish there was no tax liabilities attached to the money. I know, it's funny, right? The money I invest for life insurance that pays me some reward of a dividends periodically, but of course, there
are instruments for that, right? It's a tool that can be leveraged in a tax efficient manner. So nobody wished, we all wish we didn't have to pay taxes, right?
Well, in some situations, right, we wish we never. I know we will have to pay taxes.
There you go.
On a policy that is, let's just say this may just go back to the creator of this policy, because and maybe the right questions aren't being asked. Also,
so the thing about it is that the insurance companies have to work, with the government, with the tax administration, within the government as well, to ensure that the policies align are in concurrence with whatever the tax legislation is at the time. That will change and they take on new forms over time as well. The point I'm making though is that the reason why I brought up the issue of taxation is because it is something that has to be a part of the conversation
Yeah.
whenever you're talking about withdrawing money,
Yeah.
or if you're setting up like a permanent insurance policy for the purpose of leveraging the cash value within those contracts. You want to be having those conversations, again, with your tax experts, your tax accountants, so you know what the tax implications are. In many cases, there are ways to mitigate those taxes. Right.
You
So
want to give us any examples of that?
So-
so we're here, man. We want
Yeah.
we want all the gems, my friend.
right. So there are ways to mitigate the taxes.
Yeah.
Companies will offer, a lot of these insurance companies will offer what is called a policy loan,
Yeah.
right? So you can, instead of liquidating the asset, you leverage the asset,
Okay.
right?
Now you're giving us something.
Right? No, I mean, so that's, it's a concept that a lot of people struggle with.
Yeah.
Because people say, Dermaine, why should I borrow against my own money?
Yeah.
Right? But it's the same reason why you would borrow against land,
Yeah.
or you would borrow against your home.
Yeah.
If you're in a jam and you have a home valued at 400,000 or $500,000, and it's mostly paid up, you could leverage that property
Yeah.
for a $50,000 loan.
Yeah.
Right? It's the same concept, right? Why do we leverage? We leverage in order to preserve assets.
Yes.
All right. So if you have a whole, let's say a permanent insurance policy,
Yeah.
and you want to access some capital, some resources from it, but instead of going and cashing in the policy or
Yeah.
a portion of the policy,
Yeah.
you could leave the policy in place. We like to speak about the cash value within the policy as the engine
Yeah.
of the policy, because whether or not you're attracting like a rate of return, or you are attracting like a dividend, at the end of the day, that is what is attracting those dividends, right?
Yeah.
If you're being paid a dividend, the dividend that you paid is pretty much on whatever you have within the contract.
Yeah.
If you're earning interest, it's going to be on what you have in the contract.
Yeah.
So if you go and you take away a portion, then you're actually going to reduce your earning power.
Yeah.
But if you leave this in place and you go and you leverage it, now it's like you're having your cake and you're eating it too, in a sense.
Kind of difficult, but I
Yeah,
Yeah.
that's why I said it's not completely, but it's like you're having your cake and kind of
Yeah.
eating it too, because you still have the money.
I know.
You
Yeah.
still have the cash value. That means it can still attract a return.
Yeah.
Based on the maximum amount you have there, while you're leveraging the same asset elsewhere. It's a beautiful thing.
The caution there, Dermaine, is not to over leverage.
Absolutely.
Because leverage has its advantages as long as you're not over leveraging. Because the aim is to make sure that at the end of the day, you can still cover whatever you're being loaned. Because
Absolutely.
when you borrow, whatever you borrow, it's really not yours. But the win-win there is if you can leverage and pay back that return in the long term and still have what you were saving on that plan.
Absolutely.
So I guess it's to understand, the details and the fine print.
Everything within
detail.
reason. Everything
Yes.
within reason.
Yes.
Understanding, the terms, the conditions, and just ensuring that you are consulting with the right, persons.
And asking the right questions too as well.
Yes.
All right, moving on to health insurance. What are the key things people should look out for in health insurance plans? I think health insurance is absolutely important. Let me just say that.
Health insurance is important. It's way more important in certain jurisdictions where people do not necessarily have access to healthcare the way we do here in Alberta, Canada. But for sure, in terms of health insurance, it's always going to be dependent on what is most important for that individual client. Let me give you an example. I've had clients reach out to me and they're like, "Hey, Dermaine, I would like to get a health plan, but I want to have really good optical benefits, or I want to have really good dental benefits, or I'm looking for a plan that has really good prescription benefits." So you find that the need of the client will vary based on their own individual circumstances. Where you have an individual that perhaps was born with a certain condition that necessitates them to be on medication for a lifetime, prescription is going to be the number one need. So they're going to be looking for a health plan that's giving them the most coverage for those prescription benefits and stuff like that. So it always varies. You know, what is important though is that people are really assessing whatever plans they get through their employer, right? Assess the plan you get through your employer, know exactly what you're covered for. If you are an independent business owner, or you're a contractor, or you work for yourself, right? Then you know you have no health benefits in that case, right? So you now need to build a plan for yourself. So this is where you know, we can help our clients to shop around, find a really good health and dental plan that kind of suit their needs and their family's needs as well.
Okay. Are there any, I mean, could you go more detail? Are there any types of plans that, let's for example, covers a number of things in a basket? Does any of that exist?
Yeah, so in terms of the types of plans, there are, right? You could go to any company out there, major health insurance provider, and they would have, like, you know, a full basket with lots of options for the client. Some will be a little bit more generic, some will be a little bit more specific, right? And so, you know, you may find that the pricing, you know, and the coverage varies, again, depending on, again, what the needs of those clients are, right? Okay.
Let's talk about property, liability, and business insurance. Can you give us an overview?
Yeah, so I can give you ideas. This is not necessarily an area where I have any specialty in, but we do work with, you know, people that have the requisite qualifications and experience within these fields. So most of that stuff I do, you know, refer out. You know, so in terms of liability coverages, those will vary. It's very important to have liability coverage in place. Again, if you are involved in business, if you're hosting a special event where you're inviting guests out, right, you can be held liable, you know, in many different instances. So you want to ensure that you have those liability coverages in place. It's just going to ensure that you have that legal, that protection in place to protect you should there be any kind of legal implications, you know, from doing business or hosting your event or whatever that looks like.
From your years of experience, Dermaine, have you heard of any situation where, let's say, a particular individual was hosting a party or some concert or some event for that day, and something happened, and luckily they had some insurance that they were covered for? Have you heard of any scenario in that regard?
Not personally. I don't want to. I wouldn't think that those incidents happen a lot, but I have known of instances where you know, persons got injured at private parties.
Oh yeah, that's what I'm making reference to.
And there were like you know, litigation coming out of that, right? So it does happen.
Of course, I'm sure of it. I'm absolutely sure. Let's just
it does happen.
Let's shout this out a little bit louder. Ladies and gents, you can have a party at home or an event at a some auditorium somewhere that you are responsible for. And someone that is attending that event have a slip and fall, or there's a fight and somebody get injured in the crossfire. Guess who is liable for that? You,
the host. Yes, the host.
So
the host.
Let's emphasize this, that these things happen.
It happens. Yes, it does.
And we are in North America, where people like to sue for various situations. So please be mindful, gents and ladies. Be mindful and get coverage.
No, it's important to get those coverages in place. I do believe once persons are hosting a legal event, fortunately, you know, the checks and balances in place do require persons to actually get permits and you know, requirement of those permits is that persons actually have the requisite insurance coverage, liability insurance, when they're hosting those kind of events as well. But again, you raise a very important point. Like, even if you're having something at home, you're not going to require a permit in that event. I guess if your crowd is not necessarily too large, but you probably want to think of, covering yourself there.
Choose who you invite.
You still never know.
It's your household event. Choose who you invite. Okay? Because I guess you never know. Now let's shift gear into one of my favorite topics.
Okay.
Investment strategies. What are some common investment strategies that individuals should consider?
Yeah, so I'll speak a little bit more to my client base.
Of course.
Because that's the demographics who I work more closely with. So a lot of people from the middle income families, sometimes lower income as well. Sometimes these clients are newer immigrants to Canada. And so, in terms of, wealth accumulation strategies, what are some options out there? There are quite a few. I want to start off by saying it's very, very important that persons are not trying to do this by themselves. Oftentimes people think they need to go out and learn about investments, learn about the stocks, learn about, day trading and all of these things. And what happened in a lot of those cases is that a lot of time pass and they would not have achieved a lot. Right? Because it does require for you to do those things personally for yourself. It does require a lot of time. It does require a lot of commitment, and it requires quite a bit of consistency. So I have a very good friend of mine. He's been, trading, day trading or something similar to that. And sometimes he calls and he's very excited. Another time he calls and he's not that excited. He has been doing that over the course of several years. And he had recently concluded that this thing is not worth in my time. Right? And so therefore what I'm saying is if persons are looking at investment options, there are a lot of options out there. But first and foremost, whatever you're going to do, you want to really evaluate your financial position. Ensure that you're not doing anything that is going to tie up your money in a way that it's not accessible when you're going to need it as best as possible. So you need to be thinking about, okay, what is my risk tolerance? What is the investment time horizon? Okay, let's say I want to invest $10,000. I'm okay with investing that money for 5 years, or am I okay in putting that money for 10 years, 15 years, 20 years, or whatever the case is? We really need to quantify those particular questions, and they need to be asked. Right? Ensure that you're understanding the process. So whatever account you're setting up with your advisor, you need to understand the process. Is the money going to be locked in? Right? Or is it accessible? Is there going to be some kind of fee that is assessed if I should take the money before a certain time frame? Right? All of those things needs to be asked. I'm not sure if I'm answering the question exactly the way you expected it, but
you are on track with the intro of investment. But let's use a scenario, Dermaine, because most persons don't understand the stock market, and their knowledge base is probably secondhand in terms of they hear this over here, and maybe they're not from homes where their parents talk about investment, but they're now adults. That time has passed, and they want to put away some money for long term. And I'm going to give you a specific time, 5 to 10 years. They want to lock away some money for 5 to 10 years, maybe longer. But for now, what advice would you give as to what vehicle they should use to invest those funds?
I want to say, Joel, I don't have enough information to really give a definitive response as to what vehicle would be most appropriate, because
a medium risk vehicle.
I mean, even so, as a financial professional, there's so much responsibility
Yeah.
that is on us to ensure that we're doing a proper and thorough assessment with the client.
Okay.
So sometimes it's not just about the money that is being presented or
Yeah.
the money that is on the table. It's also what is going on outside of those monies.
Okay.
You see what I'm saying? Like, I have clients come to me all the time telling me that, I want to put away $200 a month, but at the same time, they have a credit card, a $20,000 balance at 20%. Right?
Why is that?
19.99%.
Why is that? Okay, so you're saying that based on how you operate, you need the bigger picture?
It's not just the bigger picture, but is to, as best as possible, get a holistic picture.
Okay.
Right. So, when we are, focusing on the area of wealth accumulation, right?
Yeah.
That means we want to set up certain accounts in place, right? We want to ensure that we're doing that against, the backdrop that, okay, I have taken care of these other areas, right? It shouldn't be that somebody is putting away $200 a month when they have a huge amount of debt outside of a mortgage and probably a car payment. But let's say they have a huge credit card bill, or they have a huge personal loan that they're paying at 30+%, 40+%. You probably want to tidy that up first. So that's what I'm saying. It's kind of.
But what if the situation is that I don't want
ideal.
I don't want you to know about any of that. I come into your office with $50,000.
Yeah.
I want to invest this $50,000. I don't want to tell you about my credit card debt. I don't want to tell you about all the girlfriends I have, God forbid. I don't want to tell you about all the children or whatever, my responsibilities in another country. I want to invest this $50,000. And I want to know if you can give me a 10% return annually, or what is it that I can gain on this $50,000 annually? Where would you put the money? How would you go about doing it?
Yeah. And
establishing that vehicle for me to say, okay, this money is at work when I'm sleeping.
Right. So that's a fair question. We have quite a number of tools in place and resources in place. Because I operate on a brokerage platform, so I can always shop around, find the best investment portfolios for my clients and get those set up, right? When it comes on to,
is it possible for me to get that 10% return?
Well, that's what I'm touching on now.
Okay.
So when it comes on to rates of return, we can make reasonable projections based on historical trend. But we can never promise. Right, a client a certain rate of return. If you want to be getting like a guaranteed rate of return, you're probably talking about a guaranteed form of account, right? So in Canada, we have something called a GIC, Guaranteed Investment Certificates, but those comes with their downfalls, right? A GIC, for example, it's guaranteed, but guess what? Usually the returns are very, very minuscule. Compared to what you could get otherwise. And so there are checks and balances, there are pros and cons. I tell my clients confidently that if you're looking to invest, you're looking to accumulate wealth, we can help you with that strategy. We're able to help our clients get very good rates of return on their monies over time. I cannot put a figure on that on air because of compliance reason. I can't tell you 10%, I can't tell you 20. What I can tell you is that my clients are very happy. Right?
Okay, so create a description of that hypothetical, Dermaine. I mean, we're not saying that is what you've seen or done. But is there an hypothetical that you can use to see we did this, we took this path, this was the end result?
Yeah, that's what I'm saying. I can't speak because of compliance reasons. Understand me, Joel. I'm not trying to dodge any of your questions, but I work.
Isn't he dodging my question?
No, I work within a highly regulated industry, so I have to be mindful of what it is that I say and what it is that goes out there.
I understand.
I just want my clients to understand that if you're looking to grow wealth, to accumulate wealth in various forms of accounts that we have available in Canada. We have options available for you that perform very well.
Can you tell us about those options? Any of those options?
Yeah. So for me personally, I offer segregated funds.
Yeah.
Right. They comes with insurance protection on those balances. Right. So there's a death benefit guarantee. There's a maturity guarantee.
Yeah.
It comes with estate planning benefits as well. So if a client should pass, for example, the monies from the seg funds would pretty much go straight to their beneficiaries.
Okay.
Right. And stuff like that. So we do have really good options, Joel. I don't know how much more specific I can be on this.
You mentioned segregated funds.
Yeah.
What returns does that have?
This guy.
You can give me approximate figures.
Yeah. So
yeah.
What I'm going to say is, if persons are curious
Yes.
to see what we have available, please connect with me. We can sit down one-on-one. We can go through a couple examples. We have the fund fact sheets. We can review fund fact sheets for different funds. Kind of show you the historical trend and justify why it is that I have this level of confidence that I have.
Okay. Any other investment funds apart from segregated funds that you use?
So for me personally, it's mostly segregated funds that I do. I'm not mutual funds licensed. So mutual funds licensed. So I do mainly segregated funds. I personally do prefer seg funds.
What's that one?
Segregated funds over the likes of a mutual fund because of the added benefits it comes with, right? In terms of some of the stuff that I mentioned before. Guarantee, right, on the maturity. There's a death benefit guarantee. So for example, a client invested a certain amount, they pass off. If the markets were down at that point, they could potentially get a top up to a certain amount. It could be up to 100% if that's a contract. It could be up to 75%. But it's really additional protections that are actually in place to protect those monies for the clients. And so my clients are really able to sleep well at night, knowing that their money is safe, and they are getting very, very healthy returns as well on their deposits.
You made reference to a point that I want to touch on. How do you determine which strategy is right for an individual? I know you started talking about that. Can you reiterate on that one?
So how I determine what strategy is right for the client is really by doing a thorough client assessment. All right. It's very important as financial professionals that we, again, take a very holistic approach to assisting the clients, because many times the client will come to you and they'll say, Dermaine, all I want to do is this, or all I want to do is that, right? Because they don't really understand how the different parts work together, right? And if I don't do my job well, I'm going to have the same client knocking at my door a few weeks down the road telling me that they want the same money that they wanted to invest. Is what I'm saying.
Have you seen that?
It happens.
Okay.
It happens.
Okay, so.
Right? We are the professionals. We understand, the nature of how the finances work together, and stuff like that. So that is why it's really our responsibility to provide that guidance and provide that reassurance to the clients as well.
Okay. So based on, do you believe in diversification at all? Where investment is
absolutely.
concerned?
Absolutely.
Can you talk about that?
So diversification is very, very, very important in terms of what it is I do for my clients. As it relates to wealth accumulation of their accounts. Why is that is so? Is because with diversification, you're able to pretty much reduce your risk exposure. One could go and put all their money on one particular company. But what if you were able to spread that same deposit across tens of companies, or scores of companies, right, or hundreds of companies? Then it reduces your risk, right, of you losing out at the end of the day because of that spread. The likelihood that 100 companies going to do bad the same year is very unlikely, right? But when you're hinging on just one particular company, then the risk is that much higher.
Let's touch on another one of my favorite topics, Bitcoin. We all know that this is becoming a talk of the town where investment is concerned in this new digital gold. Is any of your connections or business partners, is there a discussion on the topic of Bitcoin where investments are concerned?
Yeah, so what I've found is the conversation have cooled down quite a bit surrounding Bitcoin, and that happened largely because of the significant downturn we had in the price of Bitcoin a few years back, right? So I'm not getting a lot of inquiries the way that I was when Bitcoin was doing well.
What are some of the inquiries you got in previous times?
I mean, persons were just calling me or they were texting me like, hey, Dermaine, what do you think about Bitcoin? Should I put some money there? Stuff like that, right? I was getting a lot of those inquiries, quite a bit. But as I said, as time went by, the curiosity of most people I have noticed have kind of cooled down a bit. It has reduced, so not that great amount of interest as we were seeing during the COVID era, right? Post-COVID era, stuff like that.
And don't you think that Bitcoin will become a thing of the future where investment, I mean, your opinion?
I think we're still along.
The reason why I ask is that we're looking at some of the biggest hedge funds picking up lots of Bitcoin, the BlackRock, the Morgan Stanleys, and banks that never once used to talk about Bitcoin. They are hoarding Bitcoin for themselves. So the reality is that if these mega conglomerates are investing, storing up, buying the dips, why is it not a talk of the town in your investment arena?
It could be, again, partly because of the demographics that I serve.
True.
I believe that have a whole lot to do with it. Certainly, there are people who do participate to some degree. I have clients that own certain amounts, maybe not significant portions, but they do dabble a little bit in not just Bitcoin, but various kind of currencies, cryptocurrencies, right? It is something that's there, and I generally would, advise my clients just to be very careful, when they're dealing particular with that. You don't want to put your retirement money, in a cryptocurrency per se, unless you are very, very confident and certain about what it is that you're doing.
Of course, we're not going to sell the farm to put it into Bitcoin, but but the reality is that, Dermaine, it is becoming an investment item, and I think and we're gonna hear more about Bitcoin now and in the future. I do believe in it. Would you invest in Bitcoin, Dermaine?
I mean,
why and why not?
For me personally, I'm not sure, to be honest with you.
Okay.
I am not sure if I would necessarily partake in it. Let's see what happens when that time comes.
Or is it a case that you don't know enough and it's
That could be partially it as well. I think I know a little. And I've seen what it has done over time, but it is definitely not the most attractive
right now
form of way to grow wealth for either me or for the majority of my clients, particularly because of what we were talking about prior to this. The risk level is really, really high.
It is high risk.
Right. I mean, most people run to Bitcoin because of the historical returns that it has achieved in the past, and they're hoping that those same returns will some way, somehow happen again, right? I mean, it may and it may not. But when I sit with my client, my primary, one of my primary objective is to ensure that whatever we're doing is going to be something that is secure, something that is going to be there, 20 years, 25 years down the road, right? I don't want to be at the end of that call,
Where's my money?
when it is all gone, right? So, I'm happy, with the companies we work with, the kind of partnerships we have. Majority, all of what we provide is really, within, it fulfills the criteria of a very, very stable, credible, reliable form of wealth accumulation strategy.
Well said, well said. Okay, so what are some of the tips and advice you have for our listeners when it comes to insurance and investment strategies? Do you have any tips?
Yeah, I have a few.
Yeah.
So let's talk about the insurance first. One of the things I educate my clients about is that your insurance is fundamental. It's foundational to building a successful financial future. In Canada and in any place you live, really, right? It is really foundational. It is that aspect of your. Think about your insurance as the structural foundation of your financial house, right? Now, look at this building, for example. We're not seeing the foundation. It's all finished up. It's looking beautiful, well painted, well decorated, well furnished. We're not seeing the foundation, are we? The foundation is nowhere inside because it's buried beneath the ground. But it is absolutely critical to the integrity of the entire structure, isn't it?
True, very true, absolutely.
So, our insurance provisions is that foundation for our financial structure. Right?
Well said, Dermaine. So where can people follow you? Subscribe to any platforms you're on, reach out to you for advice. You want to share that?
Absolutely. Well, I'm easy to find. I pretty much go by my full name, Dermaine Whittaker. You can find me on IG. I'm on Facebook. Those are my main go-to social media sites. I do have a presence on LinkedIn as well. If persons want to connect to me there, but I'm not there very often. But I'm on LinkedIn as well.
There you have it, ladies and gents, a very insightful conversation we've had today. Thank you so much, Mr. Whittaker. We've covered a lot of grounds, from understanding the various types of insurance that can protect you and your loved ones, to exploring a range of investment strategies that can help you build and preserve your wealth. Dermaine Whittaker is the expert in this department, and we do appreciate your valuable insights, sir. Don't hesitate to consult with Dermaine Whittaker, who can tailor these strategies to your specific needs and goals. Everyone's situation is unique, and professional guidance can make a big difference. To our listeners, thank you for tuning in to another episode of the podcast called One Step. Let's talk about the journey. If you enjoyed this episode, please subscribe, leave a review, and share it with your friends and family. Stay tuned for more insightful conversations. Until next time, God bless, take care, and bye.
Well said. Thank you, sir.
You're welcome. All right, let me hit this.